Hi, thank you for joining us for the third quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strage. The third quarter got off to a great start in July with the S&P 500 up over 9%, but unfortunately the rally did not last, and the stock market index is up about 0.5% for the quarter with about a week remaining. For the year, the S&P 500 is down nearly 20%, and you can see that the stock markets across the globe are down a little more than that. Bond indexes also continue to suffer as interest rates continue to rise. The Bloomberg U.S. Aggregate Bond Index is down about 13% for the year. Bonds can typically be relied upon to provide more stability to a portfolio. But we are experiencing an unusual year where nearly every asset class is down, and having a diversified portfolio has not been too beneficial. This chart shows that of the hundreds of various mutual fund categories, 93% of them have had losses this year. Only a few categories, such as energy and commodities, have had gains this year. This graph shows that the losses have varied significantly across different parts of the stock market, however. The large growth stocks, which include many technology companies, such as the Big Five of Apple, Amazon, Microsoft, Google, and Tesla, have lost nearly 36% over the past year. However, large value stocks, which include companies that might not be growing as rapidly, but are trading at a lower price relative to their earnings or assets, have only dropped about 4% over the past year. They can lag growth company performance from time to time, but over 10-year rolling periods, value stocks outperform growth stocks about 80% of the time. This might surprise people, but maybe the simplest explanation is that while growth companies gain a lot of attention and become popular, investors tend to pay too high of a price for them, and they are unable to keep up with their high growth expectations. Inflation continues to persist and is the biggest risk to the economy. Headline inflation, which includes food and energy prices, dropped from its peak in June of 9.1% down to 8.3% in August. However, investors were expecting a bigger drop, and markets suffered as a result. Lower gasoline prices are starting to give consumers some relief, but core inflation, which excludes food and energy, actually rose unexpectedly in August, which is a sign that it will likely take a while for inflation to fall back to more normal levels of 2 to 3%. As a result, the Federal Reserve continues to be ultra aggressive in their pursuit to lower inflation by raising interest rates. The Federal Reserve again raised rates at their September meeting by another 0.75%, which brought the Fed funds target rate to 3.25%. The majority view of Fed officials is that they will raise rates twice more this year to a level around 4.5%. That is over 1% more than what was expected at the end of the second quarter, and therefore was the big reason that markets did not rebound in the third quarter. There is some debate whether or not we have already had a recession. The most common definition of a recession is 2 consecutive quarters of negative GDP, which has happened this year. However, in the U.S., recessions are officially designated by the National Bureau of Economic Statistics, which is a nonprofit that maintains a committee of economists that study a broad range of economic data to determine recessions. Some economists believe we cannot be in the midst of a recession when unemployment is below 4% and consumer spending continues to be positive, as people continue to spend down the trillions of dollars that were saved during the pandemic. So if you're looking for clarity on the state of the U.S. economy based on current economic data, you likely won't find it. Depending on the metric, we could either be in a recession due to high inflation and interest rates, or the economy could be healthy based on employment, consumer spending, and corporate profits. The reality is likely somewhere in the middle. Here are a few important points to remember when it comes to managing your portfolio during uncertain times such as these. First, do not sell your investments while in a market downturn unless you absolutely have to. For our clients that are in retirement, we plan ahead and try to have them maintain sufficient cash or more stable investments to draw from to help them get through a downturn and allow their growth-oriented investments enough time to recover. Second, don't try to time the markets. When the markets are down, it can be tempting to try to get out before more losses are incurred. However, it is difficult to know when to get back into the markets, and often the largest market gains occur in just a few days. For our clients that are still working and accumulating assets, market drops are an opportunity to buy at a lower price. Follow the advice of Warren Buffett and be fearful when others are greedy, and be greedy when others are fearful. Third, remember market downturns don't last. According to the Schwab Center for Financial Research, going back to the 1960s, the average bear market lasted about 15 months with an average loss of about 38%. Those are not fun to live through. However, the average bull market runs for about 6 years and delivers an average return of over 200%. If we keep a longer perspective of the market, these downturns can just look like blips on the radar. Our job is to select the best investments to meet your goals and then to help you manage your emotions to stay invested in them. We will continue to monitor the markets and your accounts and make adjustments as necessary while taking a longer-term perspective. Thank you for your continued trust, and we look forward to having many year-end conversations with you. Take care.